Something quiet has been happening in the silver market, and most people have no idea it even started. Not the kind of thing that makes front page news, not the kind of thing your broker calls you about. But if you pay attention to where real money actually flows, and not just where the headlines point, then what's been unfolding in the silver delivery cycle right now deserves your full attention. Because here's the thing about markets. The really important moves rarely announce themselves with a trumpet. They start as whispers. Small frictions, small mismatches, small questions that most people brush aside. And then one day, those small questions become very loud answers. We are not at the loud part yet. But the whispers are getting harder to ignore. So today we're going to walk through the whole picture. The real data, the real structural story, what the physical market is actually saying, what the paper market has been doing, where the two things diverge, and most importantly, how you should be thinking about all of this without losing your head or your perspective. Because there is a real story here. And there is also a highly theatrical, emotionally charged version of that story that keeps getting mixed in with the real one. If you cannot tell the difference, you're going to make worse decisions, not better ones. If this is the kind of content you find useful, the kind that actually slows down and works through the evidence instead of just trying to scare you into clicking something, then hit subscribe right now and stay with me. At Element Axis, this is exactly what we do. We take the things that matter in the metals market and break them apart piece by piece until the picture is clear. So let's get into it. Let's start with where silver has actually been trading relative to gold, because this is where a lot of the excitement has come from recently. Silver did start asserting itself in a way that got attention. For a stretch, it was moving harder and faster than gold. It was picking up relative strength. The gold to silver ratio was beginning to compress. And whenever that ratio starts compressing, the crowd that watches these markets very closely gets excited. Because historically, when silver starts running faster than gold, it can run a long way before it stops. Even after a week, where both metals got hit by a stronger dollar and rising yields, silver had already done enough on the upside to remind the market that this metal has torque. When it moves, it really moves. It can shift fast and hard in both directions. That part of the story is real. Silver is not just sitting quietly in the corner anymore. But here is where I want to slow things down, because this is where the story can get away from you. A lot of people look at that ratio compression and immediately jump to a very clean conclusion. They say silver is going to explode to the upside, and we are going to see a straight line move that closes every historical gap all at once. I understand the appeal of that story. It is clean, it has a villain, it has a trigger, and it has a glorious ending. But markets do not operate on clean narratives. A ratio compressing tells you something real. It shows relative strength. It shows when one metal is beginning to outpace the other, but a ratio is not a clock. Ratios can compress because silver is genuinely strong, because gold takes a breather, or because speculative positioning unwinds for reasons unrelated to physical scarcity. So yes, note the ratio, take it seriously. But do not let it become your entire worldview. And this matters because the silver story right now keeps getting packaged in one very specific way. Paper suppression pushed the price down artificially. The East is buying real metal while the West is still stuck pricing things off futures. March delivery is the moment of reckoning. And once that moment cracks open, the whole thing cascades into a gold story, then a credit story, then a currency story, and before you know it, the entire monetary system is coming apart by next Thursday. That version is emotionally powerful. It is also extremely incomplete. If you buy into the whole package without examining each individual claim, you are not doing analysis. You are doing theater. And theater has a real cost when real money is involved. So let's take the paper market argument first, because this is where the emotional charge in the silver community really comes from. The core claim is that silver has been pushed lower not by people actually selling physical bars, but by contracts, by futures, by leveraged paper positions that have nothing to do with real metal in a real vault. And the honest answer is that yes, futures markets do influence price discovery in the short run. That is not a conspiracy. That is just how derivative markets work. They are large, they move fast, and they are used by traders whose only interest is the number on the screen. A big futures move can ripple outward and affect the spot price before physical conditions have a chance to respond. That is real. But saying futures affect price is not the end of the argument. It is the beginning of a harder question. Are those futures moves just normal price discovery within a functioning market? Or have they become so divorced from physical reality that they are genuinely unsustainable? Those are two very different situations with two very different implications. If you want to argue the second version, you need more than outrage. You need structure. You need to show that what is happening in the paper market cannot hold up against the physical market. That is a much higher bar than pointing at a futures move and saying manipulation. Silver futures at COMEX exist inside a regulatory framework. There are position limits, open interest data published regularly, delivery notices, settlement procedures, and warehouse stock reports that are publicly available. The argument is not that there are no rules. The more serious argument, if you want to make it, is that enforcement gaps, exemptions, and concentration of market power may still leave room for distortions even within that framework. That is a legitimate concern, and it is also harder to prove than most people want to admit. When someone shows up with one anecdote from overseas and treats it as ironclad proof that every Western price move is a coordinated takedown, that deserves skepticism. The strongest case for silver does not depend on any of those claims, and that is what I want you to hold on to. Because the real silver bull case, the one that is most durable and most difficult to dismiss, is not the most theatrical one. It is the one that survives after you strip away all the noise. Drop the conspiracy framing. Drop the apocalyptic language. Drop the claims that cannot be verified. What do you have left? A market that has been running structural deficits for years. Industrial demand that just hit another record. Supply that is not infinitely responsive to higher prices. A metal placed on the United States critical minerals list. And a growing recognition in policy circles that this is not just a coin shop commodity. It is a strategic resource. That story stands on its own without any extra drama. And I want to be clear about the demand picture, because this gets oversimplified constantly. People still talk about silver demand as though it is one big undifferentiated wave of buyers all doing the same thing. It is not. When you look at the actual data, what you see is multiple demand engines running at different speeds. India has been a major source of jewelry and fabrication demand. China remains central to industrial consumption. Western coin and bar demand cooled in the most recent annual data. But electronics and electrical demand kept climbing, with solar, automotive, and AI-related hardware trends adding further support to the industrial side. This makes the bull case more resilient. If silver demand depended entirely on retail investors buying coins and bars, then a cooling in that category would genuinely weaken the picture. But when industrial demand is doing heavy lifting while investment demand is soft, and when regional centers like India are pulling strongly, you have a demand base that does not need everyone to fire at once to keep the balance tight. The market has been tight even without a full retail panic. Think about what happens if that retail wave ever comes back into a market where industrial demand is already pressing hard against supply. That is a setup worth paying attention to. Drop a comment below right now and tell me this. Are you currently holding silver in physical form, through paper exposure, or not at all? I'm genuinely curious about where people in this community are positioned, and your answer might help someone else reading these comments figure out their own situation. Now let's talk about the supply side, because this is where the story gets a structural layer that most casual observers completely miss. A large portion of silver production is not from mines that exist primarily to produce silver. A significant share of output is byproduct, meaning it comes as a secondary product from operations primarily going after copper, lead, zinc, or gold. That means silver supply is not as directly responsive to silver prices as you might think. If copper economics are weak or zinc operations scale back, the byproduct silver from those operations does not come out either. A higher silver price alone does not fix that. And permitting is slow, mine development is slow, refining, and logistics all have to line up. You do not go from a higher silver price to meaningfully more supply in a matter of months. You are talking years in many cases. The neat idea that higher prices will instantly solve a deficit is too simple. Supply responds, yes, but on its own timeline, not the market's preferred one. And there is something about the United States specifically worth mentioning. Domestic data shows the US is still heavily reliant on net imports for silver consumption. That does not mean America runs out of anything, but it means American silver supply is part of an international supply web with friction points, shipping costs, financing conditions, regional premiums. When you depend on imports for a critical industrial material, disruptions in the chain feel sharper and faster. Silver does not need global scarcity to feel locally tight. It just needs enough strain at the right point in the chain. Now let's bring London into this, because LBMA gets mentioned constantly without much clarity about what it actually means. London is a clearing system that moves more than 200 million ounces of silver on a net basis each day. That is the center of gravity for global silver trading. When people look at London Vault data and see large holdings, they sometimes ask how the market can be tight if there is so much silver in the system. The answer is that large gross pools and tight available flows are not the same thing. A market can show an impressive total and still have limited metal that is free to move on short notice. Allocated versus unallocated, encumbered versus available, vaulted versus eligible for delivery. These distinctions matter enormously when conditions get stressed. That is often exactly where repricing begins. If you are finding this breakdown useful, this is a great time to like the video. It genuinely helps this content reach more people who are trying to think through these markets seriously, rather than just reacting to whatever the loudest voice said last. Hit like and keep watching. Now let's talk about the actual delivery picture, because this is where a lot of the March excitement has been centered. Claims have been circulating that the entire COMEX open interest stack was essentially lining up to bang on the warehouse door at once, that the numbers did not add up, that the system was mathematically guaranteed to fail. Here is what the official exchange data actually shows. Total silver futures open interest across all contract months was very large going into this cycle, somewhere north of 500 million ounces in notional terms. But when you isolate the March contract, which is the one that matters for this specific cycle, the picture changes. The amount of open interest remaining in March had already declined dramatically as delivery pressure was building. Month-to-date deliveries were running above 30 million ounces, which is real and meaningful. But that is not the same as saying the entire exchange was one bad afternoon away from collapse. Not everyone holding a futures contract is trying to take delivery. Different months serve different purposes. Many positions are directional bets, spread trades, or hedging operations that get rolled or closed before delivery is ever relevant. When people take total open interest across all months and present it as tomorrow morning's warehouse demand, they are telling a scarier story than the data actually supports. And the exaggerated version does not strengthen the silver case. It weakens it. Because when the exchange gets through the cycle without a dramatic failure, people who bought into the theatrical claims walk away more skeptical of the whole thesis. They do not update their view on supply deficits and industrial demand. They just decide it was all noise. The real argument is strong enough to not need that kind of framing. Now suppose delivery stress does intensify. Suppose registered stocks tighten further. Does that automatically mean all contracts go to zero and the global financial system implodes overnight? No. Exchanges have tools. Participants can roll positions. Large players can source metal from outside registered stocks. A serious squeeze creates violent repricing and forced adaptation. But extreme volatility is not the same as civilizational collapse. The more realistic path if strain builds is repricing, dislocation, and behavior changes from participants who cannot close arbitrage gaps the way they used to. Severe, significant, worth preparing for. But still within a framework of incentives and adjustments. Let me tell you what a real warning sign would look like from here. Genuine deterioration in market confidence would show up as persistent physical premiums that do not fade. Not premiums that appear for a week and normalize, but premiums that stick and widen. It would show up as growing sensitivity around delivery months, even in routine settlement windows. It would show up as behavior changes from large players who normally act as arbitrageurs and suddenly stop treating spreads as easy money. Those behavioral signals matter more than any individual data point. Conversely, what would tell you the market is stressed but still functional? Orderly reduction in open interest as delivery approaches. Deliveries completing smoothly even at high volumes. Stocks that are tight but not chaotic. Volatility elevated but within a market that is still clearing. The absence of emergency interventions by the exchange working under pressure is not the same as failing. Go ahead and share this video with someone who is trying to figure out the silver market right now. If you know someone who keeps hearing the loudest claims and does not have a good framework for sorting signal from noise, send this their way. Now let's talk practical implications. Because information without a framework for action is just interesting noise. If you own silver only through paper exposure, whether ETFs, futures, or other paper vehicles, you need to understand exactly what you own. Paper products can serve real purposes, but they are not the same as physical possession. They have terms, counterparties, and settlement procedures that work one way in calm markets and potentially differently in stressed ones. The difference between price exposure and physical possession is real. Those two things can behave identically for years, and then behave very differently when conditions get tight. If your goal is trading, paper exposure may be exactly the right tool. If your goal is long-term monetary insurance or owning something outside the financial system with minimal counterparty dependency, those are different conversations. Too many people blur all three of those goals together and then do not understand why their instrument behaves unexpectedly when conditions change. The practical answer is simple. Match your instrument to your objective. That is honest portfolio design, not drama. And I want to say something about preparation, because this topic tends to produce two opposite and equally unhelpful reactions. One group hears anything about silver market stress and does nothing. The other group immediately starts preparing for the complete end of modern civilization. Neither reaction is useful. The smarter version of preparation is boring on purpose. Review your exposure honestly. Reduce complexity you do not fully understand. Decide what portion of your wealth is meant to be liquid, what portion is meant to hedge inflation or currency risk, and what portion is meant to sit outside financial intermediaries entirely. Make sure you can actually access what you own and that your custody and counterparty assumptions hold up under pressure. That is real preparation. Not exciting, but it is what actually matters when conditions change. And here is the thing about silver specifically that makes it interesting in a way gold does not quite replicate. Silver carries a dual identity. It is part precious metal, part industrial necessity. Gold can sit in a vault for decades and still perform its monetary function perfectly. Silver gets used, it gets consumed, it gets dispersed in small amounts across enormous production chains. Electronics manufacturers use it, solar production consumes it in quantity, automotive systems rely on it, AI hardware infrastructure is increasingly drawing on it. Silver is embedded in the modern economy at a level most people do not appreciate until they look at the data. Above-ground availability can tighten faster than people expect once demand and confidence start pushing in the same direction simultaneously. That dual identity is also why silver can feel disorderly in a hurry when it starts moving. Gold has deep institutional sponsorship. Central banks hold it as a reserve asset, and that creates a stabilizing cushion. Silver does not have that in the same way. It has industrial pull, monetary optionality, and a much thinner institutional cushion. So when silver starts running, it does not drift higher in a dignified manner. It moves fast, it moves loud, and it can reverse just as quickly. The addition of silver to the United States critical minerals list is a detail that got overlooked by most people focused on the theatrical arguments. But it tells you something significant. Policymakers have formally recognized that silver sits inside a supply chain that is strategically important to the national economy. When governments treat a commodity as a supply chain concern, you're no longer in the old precious metals debate. You are in the realm of resource policy, industrial strategy, and long-term economic security. That is a more durable kind of relevance than price speculation alone. The recycling picture is also worth a brief mention. Scrap recovery did increase in response to higher prices. But even with that increase in recycled supply, the market still registered multi-year deficits. The system responded and still could not keep pace. That is a more stubborn kind of structural tightness. Now zoom out and think about the macro environment that all of this is sitting inside. We are in a world where the dollar, yields, labor data, and geopolitical headlines can all move metals in different directions in the same week. The market is fast, reflexive, and increasingly sensitive to anything that signals a supply chain problem or a shift in monetary confidence. That environment creates both risk and opportunity for silver holders. Risk because volatility is real. Opportunity because a metal that is structurally tight, strategically important, and sitting inside this kind of macro backdrop can see dramatic repricing that does not announce itself in advance. If you have been watching and this breakdown is helping you think more clearly, let me know in the comments. Tell me what angle of the silver story you want me to dig into next, whether that is the industrial demand data, the London clearing picture, the supply chain geography, or the regulatory framework. Now let me bring this together because the summary matters as much as the detail. The claim that silver is being suppressed by paper selling and the claim that silver is in a genuine physical bull market are not the same claim. People blend them constantly, but they are separate arguments with separate evidence requirements. You can believe futures markets create short-term distortions without believing the entire Western financial system is a coordinated fraud. You can believe physical demand is doing meaningful work without believing one delivery month will detonate every financial contract on Earth. You can be genuinely bullish on silver for real structural reasons without signing on to the apocalyptic framing that tends to accompany these discussions. That separation matters practically. Apocalyptic framing repels exactly the kind of thoughtful, experienced investor who might actually benefit from understanding silver's structural story. When someone who has been investing carefully for 30 years hears the most theatrical version of the argument, they tune out and walk away from a situation that genuinely does have a legitimate case underneath all the noise. The real bull case is strong enough to stand on its own. Here's what we actually know from the data and the public record. The silver market has posted multiple consecutive deficits. Industrial demand has hit record levels. Silver now sits on the U.S. critical minerals list. London continues to move extraordinary daily volumes. Regional demand centers like India remain significant. Supply is constrained by the byproduct nature of a large portion of mine output, and this market can turn violently volatile very quickly in both directions. That is already a substantial foundation for a serious investment thesis. You do not need the world to end to justify owning silver. You need a market that has been structurally short of metal for years, industrial demand growing and embedded in the technologies that run the modern economy, limited supply responsiveness, strategic recognition at the policy level, and the possibility that investment demand could return to a market that has stayed tight even without it. That combination produces a higher price, and repricing does not require a single dramatic failure event. The market has its own mechanism for correcting when something is underpriced relative to scarcity. The investors who tend to do well through these periods are not the ones most convinced they know exactly how the story ends. They are the ones who know what they own, know why they own it, and have structured their exposure in a way they can maintain through volatility without being forced into panicked decisions. They can watch a rough week in both metals and say their thesis has not changed and they do not need to react emotionally to short-term price moves. That composure is worth more than any individual trade. Know what you own. Know why you own it. Understand which part of the thesis rests on solid evidence and which part rests on adrenaline. Make decisions that will look reasonable in hindsight, not just decisions that felt urgent in the moment. This market is serious. The fundamentals are real. But markets also require patience, precision, and the willingness to hold your ground without losing your head. Stay with this conversation. There's a lot more to dig into on silver, on the broader metals complex, on what the macro environment means for how you position yourself over the next several years. If you have not subscribed to Element Axis yet, now is the time. And if you found this useful, share it. Put it in front of someone who keeps getting pulled toward the loudest, most dramatic version of the story. Help them find the signal. That is what this channel is here for. Stay sharp, stay patient, and keep your thinking as clear as your conviction. Everything discussed here is for educational and informational purposes only. Do your own research, think independently, and always make decisions based on your own financial situation, risk tolerance, and long-term goals.